Silicon Valley Bank was once the darling of the tech world. With its focus on providing banking services to startups and technology companies, it was a key player in the growth of Silicon Valley. However, in recent years, the bank has fallen on hard times. So, how did this once great institution fail? Here are some possible reasons why Silicon Valley Bank failed. 1. Over-reliance on the tech sector. Silicon Valley Bank's business model was built around providing banking services to the tech sector. While this strategy worked well in the early days of Silicon Valley, it became a liability in later years. As the tech industry became more competitive and mature, many startups began to look for banking services from traditional banks. This left Silicon Valley Bank struggling to find new customers and maintain its existing ones. 2. Poor risk management. Another key factor in Silicon Valley Bank's downfall was its poor risk management. The bank had a reputation for being willing to take on high-risk clients and investments. While this approach paid off in the early days of Silicon Valley, it became a liability in later years. The bank's portfolio of high-risk loans and investments left it vulnerable to market fluctuations and downturns. 3. Lack of diversification. Silicon Valley Bank's over-reliance on the tech sector also left it lacking in diversification. The bank's loan portfolio was heavily concentrated in the tech sector, leaving it vulnerable to market fluctuations and changes in consumer behavior. Additionally, the bank had few other revenue streams outside of its banking services, which left it vulnerable to changes in the banking industry. 4. Increased competition. Silicon Valley Bank was once the go-to bank for startups and tech companies. However, in recent years, it has faced increasing competition from traditional banks and fintech startups. These competitors were able to offer similar services at lower prices, making it difficult for Silicon Valley Bank to compete. 5. Regulatory issues. Like all banks, Silicon Valley Bank was subject to a wide range of regulations. In recent years, the bank had faced increased scrutiny from regulators over its compliance with anti-money laundering regulations. This scrutiny led to fines and legal issues, which further damaged the bank's reputation and financial standing. Leadership changes. Silicon Valley Bank experienced several leadership changes in the years leading up to its downfall. While some changes were due to retirements or resignations, others were due to poor performance. The frequent leadership changes may have contributed to a lack of stability and direction within the bank, making it difficult to maintain its position as a leader in the tech banking space. 6. Inability to adapt to changing market conditions. The tech industry is constantly evolving, with new trends and technologies emerging all the time. Silicon Valley Bank may have struggled to keep up with these changes, leading to an inability to adapt to changing market conditions. This could have contributed to its failure to attract and retain customers in a rapidly changing market. 7. Poor customer service. Despite its focus on the tech industry, Silicon Valley Bank had a reputation for poor customer service. Some customers complained about slow response times and a lack of personalized service. In a competitive industry like banking, poor customer service can quickly lead to a loss of customers and a damaged reputation. 8. Exposure to high-risk clients. Silicon Valley Bank's focus on the tech industry led it to take on high-risk clients and investments. While this strategy paid off in the early days of the bank, it became a liability as the tech industry matured. The bank's exposure to high-risk clients and investments left it vulnerable to market fluctuations and downturns. Inadequate capitalization. Capitalization refers to the amount of money a bank has available to cover losses and support its operations. Silicon Valley Bank's rapid growth in the early days of the tech industry may have left it undercapitalized. This could have made it difficult for the bank to weather market downturns and other challenges. 9. Limited geographic reach. Silicon Valley Bank was primarily focused on serving the tech industry in Silicon Valley and other tech hubs. While this focus helped the bank build a strong reputation in the tech industry, it also limited its geographic reach. This may have made it difficult for the bank to attract customers outside of these tech hubs, leading to a lack of diversification in its customer base. 10. Inadequate risk management systems. Silicon Valley Bank's rapid growth and focus on high-risk clients and investments may have led to inadequate risk management systems. This could have made it difficult for the bank to identify and mitigate potential risks. A lack of robust risk management systems could have also made it difficult for the bank to comply with regulatory requirements. 11. Ineffective marketing and branding. Silicon Valley Bank's marketing and branding efforts may have been inadequate to keep up with changes in the tech industry. The bank was once known as the go-to bank for startups and tech companies, but its brand may have become outdated as the industry evolved. Ineffective marketing and branding could have made it difficult for the bank to attract new customers and maintain its existing ones. Inadequate technology infrastructure. Silicon Valley Bank's focus on the tech industry may have led to a reliance on technology for its banking services. However, the bank's technology infrastructure may have been inadequate to keep up with the needs of its customers. This could have made it difficult for the bank to provide a seamless banking experience for its clients and may have contributed to a loss of business. 12. Poor loan underwriting standards. Silicon Valley Bank's focus on the tech industry and high-risk clients may have led to poor loan underwriting standards. This could have made it difficult for the bank to accurately assess the creditworthiness of its clients, leading to a higher number of delinquent loans and defaults. 13. Failure to anticipate market shifts. Silicon Valley Bank may have failed to anticipate market shifts and emerging technologies that could have disrupted the banking industry. This could have made it difficult for the bank to adapt to new trends and technologies, leading to a loss of business and reputation. 14. Lack of collaboration with other banks. Silicon Valley Bank's focus on serving the tech industry may have led to a lack of collaboration with other banks. This could have limited the bank's ability to diversify its customer base and gain access to new markets. In conclusion, the failure of Silicon Valley Bank highlights the importance of effective risk management, adaptability, and collaboration in the banking industry. Banks must be willing to take calculated risks while also prioritizing compliance, capitalization, and technology infrastructure. By learning from the mistakes of Silicon Valley Bank, banks can position themselves for long-term success and stability in a rapidly changing market.